While the government is and will always be very proactive in cutting down the ways in which you can evade taxes by introducing provisions like clubbing of income or taxation of gifts, there are still a number of legitimate ways in which you can save your taxes as a couple. To help you understand this better, let's take the example of our Tamasha couple. In our example of our Tamasha couple, Tara is a salaried person and she earns 2.5 lakhs per annum, whereas Ved earns only 50,000 per month and he is a theatre artist. Since she earns an amount which is much higher than what Ved earns, one of the ways in which they can share the joint expenses towards their living lifestyle is by them contributing towards the joint expense account in proportion of their earnings. So in a normal scenario, Tara would contribute 60% of her income, that's 1.5 lakhs towards the joint expense account, and Ved would contribute 60% of 50,000, that is 30,000 to the joint expense account, and he would land up saving 20,000 per month, whereas Tara lands up saving 1 lakh rupees per month. Now Tara is obviously in the highest tax bracket and she's paying a tax of more than 30% per annum, whereas Ved is in the lowest tax bracket and pays a tax of only 10% per annum. An alternative way in which Tara and Ved can look to minimize their taxes is that if Ved can save 100% of his income. Now what will happen as a result of that is that Tara will have to contribute 1,80,000, that is the entire amount towards their joint expenses account, and she will be able to save only 70,000 per month from her earnings of 2,50,000. Whereas if Ved is not required to contribute anything towards the joint expense account, he can save his entire income of 50,000. Now what happens as a result of this is that over time Ved is able to save a higher amount, and those incomes that he earns from his higher savings will land up being taxed at a lower rate because Ved himself falls under a lower income tax bracket. He is under the 10% tax bracket, whereas Tara is under the 30% tax bracket. So as he accumulates higher amount of savings and earns higher investment income, for them as a family, what has changed is instead of the money being invested in the name of Tara, it is being invested in the name of Ved. But overall, they will end up paying a lower amount of tax because that additional savings are tomorrow going to be taxed at a 10% tax rate, which is the bracket in which Ved falls, versus being taxed at 30%, which is a tax bracket in which Tara falls. Well, this is a suggestion which will work based on the chemistry that you have between you as a couple and the longevity that you see for yourself as a couple over a period of time. In addition to having Ved save all his income, the second way in which the couple can look to minimize their taxes is that when they are allocating the money to the various asset classes, those asset classes that earn you an interest income or those asset classes from which you expect to earn short-term capital gains or dividend returns, you can invest all the savings of Ved in those asset classes because these are the assets which are taxed at a higher rate versus those assets that will be taxed at a lower rate, which is typically when you have long-term capital gains being earned from either sale of equities or long-term capital gains being earned from sale of any other properties or assets. So such kind of instruments can be invested in the name of Tara because she is at the highest tax bracket. So if she earns long-term capital gains, they would be taxed at the concessional rate of 10%, which is applicable to long-term capital gains. Whereas those investments or asset classes which earn interest and dividend income and are taxed at the highest tax bracket, they can be invested in the name of Ved because he is anyway in the lower tax bracket of 10%. Another way Tara and Ved can look to minimize their taxes is by having Tara claim the entire HRA against her salary by paying the rent for the house that they stay in. If you look at Tara's salary, she earns an amount of 2,50,000 a month, which is broken up into 1,50,000 as basic, 75,000 as HRA and 25,000 as other components of her salary. If Tara were to claim the entire 100% HRA as tax-free, then her taxable income reduces to 18,25,000 per year and her tax liability will be an amount of 3,72,500. Whereas if Tara and Ved were to split the HRA between them and claim 50-50% each, if both of them are paying the rent half-half, so each of them will get to claim it half. in their respective income tax returns, then the total taxable income of Tara goes up to 22.75 lakhs and her tax liability also would go up to 5,07,500, resulting in her paying a total taxes of 36% more than what she would have paid if she were to claim the entire HRA. Given the earnings of both of them, since Ved falls under the 10% tax bracket, by claiming HRA, he is able to save taxes only to the tune of about 10,000 rupees. Whereas if Tara were to claim the entire HRA, she can save taxes of up to 1,35,000 rupees. So if they plan their taxes well, wherein the entire HRA is claimed by Tara and Ved does not pay any part of the rent, the couple is able to save taxes to the tune of 1,25,000 per annum. The idea here is that if you have HRA and you are staying on rent, it makes sense for the earning member in the higher tax bracket to claim the entire HRA because they are in the higher tax bracket and that will result in higher savings, whereas the person in the lower tax bracket need not claim the HRA, offer their income for taxes and be taxed at the lower rate. The member earning the lower income can contribute towards the other house expenses which anyway do not enjoy any tax benefits. In addition to this, it is advisable that you have a tax advisor who looks at both your returns so that he can have an overall ringside view of both your income, the deductions both of you are claiming, the final taxes both of you are paying, and give you advice on the ways in which you can minimize the taxes as a couple. While the government says that both your income have to be taxed individually, both your investments need to be taxed individually, in spite of that, you can get together as a couple, be a power money couple, and minimize the taxes that you pay to the government by planning these things between yourselves. And while you can plan to a certain extent, it is always nice to have a single tax advisor look at both your returns and give you further inputs on the ways in which you can minimize your taxes.